Welcome everyone to the Richmond School of Law here, the beautiful moot courtroom, for this panel discussion about the new tax law. I'm Professor Hayes Holderness. If you haven't met me yet or taken one of my classes, please come introduce yourself. And this is my colleague, Professor Danny Schaffa. And before we begin, we would just like to say thank you to Mary Ruth Walters and Emily Cherry for helping put together this wonderful panel and all the effort they put into it. And I'm sure it'll be a great success here. We'd also like to thank Carl Ham, our IT guy, for setting up all the technical support. And if you would like to view a recording of this after everything's said and done, it'll be posted to the website. Finally, we'd like to thank Dean Perdue for all of the support and particularly for providing us lunch. So with that, I'll turn it over to Danny and we can get going.
So Congress adjusts the rates and tweaks the tax code on a regular basis, but really major reform is rare. The last time that we had really major reform was in 1986, when Congress basically eliminated several tax shelters and substantially reduced tax rates, giving us the basic system that we have today up through the Tax Reform Act in late 2017. So it's been about 3 decades since we've had major tax reform, and this, what is called the Tax Cuts and Jobs Act of 2017, is going to alter many aspects of taxation and potentially have far-reaching consequences for individuals and businesses. So corporations are going to have a substantially lower tax rate, and they can now immediately expense capital expenditures instead of depreciating them over a period of years. And the owners of non-corporate businesses will also likely see their tax burdens fall because of new deductions that are available to them. Individuals may have substantially lower compliance burdens because there is a much larger standard deduction now, and so fewer taxpayers will itemize. And on the international front, we have moved to a territorial system of taxation away from a worldwide tax system of taxation, and also introduced new taxes to help avoid base erosion and some other types of tax avoidance. And even though this can't be seen in the tax code itself, the new tax law has substantially increased the deficit, and so that also is going to have far-reaching consequences.
All right, so I think Danny and I could spend a whole day talking about the new changes, but I doubt that any of us would have as much fun or learn as much as we can from our distinguished panel here. So our experts here are here to guide us through the effects of the new tax law on taxpayers of all sorts. So we're really going to get a big picture here. And without any further ado, we'd like to introduce the panels, and then we'll turn it over to them. So first we have Kristeen Witt, who is the Director of Income Tax at Carmax. Kristeen has really done it all, and I'm thrilled to welcome her here. She's amassed over 20 years of public and private tax experience working at the government and for companies. And prior to joining Carmax in 2015, she was legislation counsel for the Joint Committee on Taxation, which is a nonpartisan committee that provides assistance to members of Congress in drafting tax legislation. On top of that, she is a certified public accountant and has a JD and LLM in taxation from the University of Florida's Levin College of Law. Next, and also part of the Florida JD and LLM tax family, we have David Sams, who is the Executive Director and Federal Staff Attorney for the Community Tax Law Project, which is the oldest independent low-income taxpayer clinic in the United States, and really the model for the national low-income taxpayer clinics across the country. Prior to joining us here in Richmond, David practiced as a tax attorney and a business attorney in Florida and Alabama, and we are thrilled to welcome him here as well.
So over here on the, I guess my right, your left, we have M.R. Litman, joins us from Williams Mullens, where she focuses her practice on estate tax planning, estate and trust taxation and administration, business succession planning, and fiduciary litigation. MR brings a wealth of knowledge with her, having worked with all types of clients from individuals and their families to businesses and nonprofit entities. She is a member of the board of Read to Them, a nonprofit organization that promotes family literacy, and a proud member of the Spider family, earning her JD here at the School of Law. Last but certainly not least, we have Bobby Johnson, a fellow School of Law alum and a proud Spider, and he joins us from Crowgey and Associates, where his practice focuses on state and federal tax controversy. Bobby founded the Richmond Council on Law and Economics, influenced Virginia tax law both through his writing and as a member of Governor Bob McDonnell's policy department. He currently sits on the board of the Tredegar Society and is an active member of the St. Christopher's Business Networking Group. And he is an alumni officer and class agent for St. Christopher's High School. So thank you very much for being here. We look forward to hearing from the panelists and also hearing your questions after the panelists are through with their piece. And so let's go ahead and kick this off.
Right, is this on, or do I have to? I guess it's on. So I'm happy to be here. I wonder the way they have this set up in a courtroom setting with the Florida grads against the Richmond grads. I didn't know about that. So as Professor Holderness, it's weird to talk to him like that, Hayes, as Hayes said, I've had a lot of experience doing different things, mostly corporate tax, pretty much all corporate tax. I worked for the Joint Committee on Taxation, which gave me a lot of insight into tax policy. And then I wanted to step out of government, and I have a daughter who lives here in Richmond, and so coming to Richmond and working for Carmax and being close to family was a great opportunity for me. So I will tell you, Carmax is not an international company, so some of the international provisions I know about what some of the policy was behind them, because some of them have been around for a long time, so I saw them at joint tax when I was working on them there. I have not seen them in practice because we don't have international operations, but I can tell you a lot about the regular corporate provisions and how they affect companies. And also, I don't know if there's any of you that are interested in accounting as well or have accounting backgrounds, but the accounting for some of these tax provisions, we just finished our year-end earnings report and earnings calcs, and the provisions in this tax bill have created some really interesting accounting questions. So if you guys have any interest in accounting, I can talk about that a little bit too. But just going through some of the major provisions, as has already been mentioned, the corporate tax rate was reduced to 21%. We're a fiscal taxpayer, an unknown until recently, a provision that I didn't really focus on before is Section 15 of your tax code. So when you have some time and want to just have some fun, peruse Section 15, which takes a provision that says is applicable to tax years beginning after and turns it into a blended rate for fiscal year taxpayers. So our tax rate isn't for tax years beginning after, but it actually started January 1st. So for us, that created some interesting difficulties in figuring out what our taxes were going to be for this year. We have 2 months of a lower tax rate and 10 months of a greater tax rate. The corporate AMT was repealed, which everyone is happy about because it's just another level of accounting for depreciation and other things that aren't fun to do. And if you get yourself into AMT, it's not fun to deal with that either. So it's nice to see that go away. For a little while, it was going to stay. Which I don't know if you guys were following the tax bills as they went through, but they had the corporate AMT actually stay in place for a little while, which made it so that the other provisions in the tax bill were really moot because everybody would have been in AMT if they had left the corporate AMT in place. So thank goodness they got wise and got rid of that. 100% bonus depreciation. So this has also created some interesting problems because it is for assets acquired and placed in service after September 27th and before January 1st, 2023. But interesting thing for corporations, we didn't really care that much about when our assets were acquired. We cared much more about when they were placed in service. So we've had to do some interesting tweaks with our systems to try to figure out when assets were actually acquired, and especially when you're building buildings, there's a whole set of case law related to when when you're building a building, when that asset is placed in service. So that's created some interesting fun for us as well. There's a limitation on interest deductions. It applies to net interest, and for car dealerships, not Carmax particularly, but for some car dealerships, there's a floor plan financing piece of that, which makes it if you have floor plan financing, so you're using your inventory to finance other operations or the operations of your inventory, you can't get bonus depreciation. So that's sort of a thing that's out there that we keep talking to our Treasury Department saying, don't ever use inventory to secure debt. So we have a whole list of things that we have to like watch for that we didn't have to before. Limitations on net operating losses. Some other things that have affected us at Carmax, the entertainment, community benefits, and meals provisions have all changed, basically disallowing any expenses for entertainment-related expenses. And so it's kind of going through everything that we do. Carmax has a very employee-friendly culture, so there's a lot of, we have events that all the teams get to participate in, and so it's going through looking at those events and seeing how much of that's going to be deductible versus non-deductible now under the new rules. Another thing that's affected Carmax a lot is the executive compensation limitation. So if you guys have looked at 162M before, there's $1 million limitation on compensation paid to certain employees. Those certain employees, the definition of those employees has been expanded, so now we have to watch them a lot longer. Once they're on the list, they stay on the list. So even after our executives retire, any payments that go out to them in terms of stock options or retirement benefits, those now are all subject to this limitation that they weren't before. There used to be a exception to the limitation for performance-based compensation. That's where you saw the buildup of stock options. That became very popular because of this performance-based limitation, and so you could exempt that from the disallowance. Now that that's gone, I'm kind of interested from a policy perspective what's going to happen to some of these different compensation packages that kind of were built around the tax law. It's interesting to me to see how the tax law changes lots of aspects about how people do business and what people think about. So that's potentially something that'll change. Just wanted to go through quickly the foreign provisions, which are huge for companies that do have international operations. Going from as you said, going to a territorial system, and some companies would argue that what we really went to was a worldwide provision rather than a deferral. So we had deferral. You didn't have to pay tax on anything until you actually brought it back in the form of dividends back into the United States. What some of the base erosion provisions have done is gotten rid of that deferral aspect. So you could certain corporations have almost gone to a worldwide tax system where they now are taxable on income or earned all over the world, even if they don't bring it back into the United States. So the base erosion provisions are quite substantial. The participation exemption system, what that means is as dividends come back in, they're not taxable. So things are taxable as they're earned or not taxable as they're earned in the U.S. now. So if it gets picked up by the base erosion provisions, it's taxable now. If it doesn't, it's never taxable in the U.S. So the base erosion provisions, they have really clever names like GILTI and BEAT. So when you look at the GILTI provision and the foreign derived intangible income provision, what Congress was trying to do was make it so that it is equal. It's taxed in the United States equally whether you are earning it outside the U.S. or inside the U.S. So if you have a company that is located in the U.S. and is servicing foreign markets, that's going to be subject to a lower tax rate on certain income that is earned on your export type earnings. On the other hand, if you are earning it outside the U.S. and you had these great double Dutch sandwich structures and all the cool stuff that people did, that income is now going to be taxable immediately when you earn it. So So the idea is people can bring stuff back into the United States now because it's going to be taxable at this lower rate, and if it's offshore, it's still going to be taxable. So the thought is that that will help bring things back to the United States. There's been a lot of policy papers written on whether they really structured that correctly in such a way that really will do that incentive, but you can read a lot about that, and I'm sure you'll learn about that in some of your policy classes. So that's sort of just the basics. I think I only have 5 minutes. I probably took more than that, so we'll pass it on, but happy to answer any questions.
Hi, I'm David Sampson with the Community Tax Law Project. Thank you for having me, and thank you for Passthroughs for inviting us. So you're a little bit more familiar with what we do. We're almost the exact opposite of what Kristeen does. We help actually the working poor, 250% of the poverty line, with their tax issues. And you're probably wondering, how the heck are the poor having tax issues? Well, they have all sorts, just the same as everybody else. So some of the things that we look at a lot are family-based issues with their denial of credits, because we basically we work with tax controversy. We're not on the planning side. So we see when the IRS already has an issue. So we're not really usually preventing issues. We're usually in the job of fixing issues, and a lot of those have to do with the family structure. We actually overall were pretty happy with the way that the new tax laws came out. We were very, very worried up until the laws were finalized, because it didn't look like things were going to be very good for our clients. So, but it worked out fairly well in the end. I'm going to go over some of the positives, because I always like to start with something positive first. I was really happy to see that the earned income tax credit was stayed in place. That's really helpful for the taxpayers that we work with. It's a huge refundable credit that allows them to bridge the gap out of poverty into the middle class. So that's excellent that that's still there. We're also happy to see that the brackets remained close to the same, because we were thinking, if they were going to crunch down to 5 instead of 7, what was going to happen? Where were some of our folks going to fall? And also, we looks like for 2018, we get a little bit of a bonus, about 3% on each of our brackets. We deal with mainly bracket 2 and 3, not the lower brackets, because they usually don't have a tax requirement. So we're very happy to see that there. We're happy to see that child tax credit was retained. We were very worried that that wasn't going to happen. The melding together of the additional child tax credit and the child tax credit, we'll see how that's implemented to see whether or not that turns out to be a good thing or not. In theory, it sounds like it's going to be fairly good, but I'm going to talk about an example that actually shows where, for certain people and certain people that are fairly common for us, that it may not be the best situation. Also, we have some things that can cut both ways. We have the double standard deduction now. So for the average person, if you're single and you're now you have an average wage, you didn't itemize, this is actually great. It's you don't have to worry about the extra exemptions that you didn't really care about. You don't itemize, so everything's pretty good for you. So that's a bonus in isolation. So obviously double the amount of deduction. Let me get to an example that I'll show you a little bit different about how things will work if you're in a situation that's slightly different than the average single person. So Joe and Jane are your typical low-income taxpayer clinic client. They make an average amount. They have 3 kids, aged 12, 13, and 15. In 2017, they claimed as married filing jointly, and they get a deduction, $12,700 in 2017 for that. That's going to jump up in 2018 to the $24,000, almost double. And then they actually can claim 5 exemptions in 2017 because of themselves and their 3 children. So that's great. Also, they actually at that point can claim 3 child tax credits of $1,000 each because their children are under 16. You're probably wondering why I just mentioned the age 16. That's the cap for the child tax credit. So now let's switch it. So in that situation, their average, they would be having a pull down on their taxable income of about $35,750 with all their deductions, not including the earned income tax credit. And in 2018, looking at the same numbers in a similar way, you're looking at about a $30,000 deduction. So in the ballpark, especially if you're looking at that 12% to 15% change over the year as far as their bracket goes, assuming they stayed in the same bracket. However, if you change the years that their children are in, if they're 17, 18, and 19, they're still living at home, parents are still paying for everything. Now you've got kids that no longer get the child tax credit. Now you're looking at a reduction of about $11,000, and that's something that 3% probably is not going to make up. So that's where you can see where a family situation can actually, it cuts both ways. So we'll probably have clients in the near future that are going to be having problems in situations where they were happily making enough money and everything was okay, but then when their kids get to a certain age, if it's within the 7 years before these laws will sunset back to the way they were before, then we have a whole different situation. So you can probably look at it, envision lots of different scenarios, just playing with a 1040 and a pencil and an eraser. You could probably envision single moms with 4 or 5 kids. We have a lot of grandmothers who have, like, they're looking after their own kids plus, 2 or 3 cousins, that kind of thing. So the non-traditional family structures can get in a situation where Congress and the way that they've structured this, going for the double standard deduction isn't going to make up for all these other deductions that they're used to having. One permanent issue I wanted to bring up, and I'm not sure if we're gonna talk about this before. In addition, is the way that they're gonna be indexing. We used to follow the CPI, the Consumer Price Index. This is one that's going to be staying permanent. That Congress has decided to follow what's called the chained Consumer Price Index, which actually doesn't follow the same trajectory. It's actually a bit slower. And you're wondering yourself, what does that even mean? That's, your job is actually going to be indexed to, for your salary is going to go up following the CPI, but the deductions and the laws in Congress are actually going to follow the chain, which is a bit flatter. So you're going to start to have a gap. And it looks like from 2000 to 2017, it looks like there was a 45.7% increase with using the CPI. And if you use the chain CPI, you're at 39.7. So you're looking at a 6% difference there. So that's, as you see, as it goes through years, you'll see the gap grow more and more, which can add problems with people jumping up quicker into categories of brackets that they're getting taxed more quicker, that their deductions are going to be following. So, much time? We're good? Okay. One last thing. The fact is, the way that the standard deduction is going to go, it looks like there's slated to be about 4 out of every 5 people that used to itemize will no longer itemize. The reason why I'm bringing that up to talk about that in the low-income context is because a lot of the services that the low-income people need to get through their life are charitable organizations. And they're very worried that out of the 4 out of 5 that are no longer itemizing, some of those people were itemizing for tax reasons and they were giving to charities for tax reasons. They're not exactly sure whether that's going to translate into less funding for the organizations that are needed for the low-income populations or not. We won't see that till next year. CTLP is one of those organizations that relies on partially on individual donors. And so we're looking at this very closely, whether or not those 4 out of 5 are going to affect how things are helping out the low-income people.
Just making notes off of what you just said. My name is M.R. Litman from Williams Mullen, and what I'm going to be talking about are estate, gift, and generation skipping transfer taxes. And even though we haven't had any major tax reform in about 30 years, the wealth transfer tax regime in this country has changed 15 times since our country's founding. So starting with the Stamp Act in 1797, we've had 15 different major changes in terms of how we do this. And so my takeaway from that is that tax reform is often temporary. And a lot of the changes that I'm discussing today, talking about estate, gift, and generation skipping transfer taxes, are only in effect through the end of 2025. So we're looking at the January 1 of this year through the end of 2025, unless Congress decides to make these changes permanent. So what I want to talk about first is kind of give you a brief overview of the major changes that affect what I do, and then second, talk about how these changes impact my clients and how my practice changes moving forward as a result. So the Act increases the federal, estate, and gift tax exclusion amount and generation skipping transfer tax exemption amount to $10 million. As of last year, it was $5 million, so it's doubling that, and that's adjusted for inflation. So for 2018, for an individual, we're looking at an exemption amount of $11.18 million. So that's over $22 million for a couple. And as I mentioned, this is a temporary change. This is not permanent. So the Act does not provide, this is something that people went back and forth on during the negotiations over the final Act, but the Act does not provide for the repeal of estate tax at any point in the future. So we're looking at increased exemptions, increased exclusion, but no complete repeal at any point in the future. Other than that, a lot of things are staying the same. So we're looking at the 40% tax rate staying the same, which has been the tax rate since 2013 for estate tax. We're also looking at the same amount in annual exclusion. So for 2018, we moved up to $15,000 a year, but that's just an adjustment for inflation. So 2017 was $14,000. So there are no real changes there. There are no major changes in the rules regarding basis adjustments at death. So an assets basis is adjusted to equal the fair market value as of the date of the decedent's death. And this is what people refer to as a step-up in basis. It permits heirs to sell assets after the decedent's death with little or no recognized capital gain. So we're in the same situation with that. One of the major issues that we are looking at in my world is this concept of clawback. So the Act adds a new section which directs the Treasury to draft regulations as necessary to deal with any difference in the basic exclusion amount at the time a gift is made versus at the time of the donor's death. And this clawback concept is that if you make a gift that's covered by the gift tax exclusion amount at the time the gift is made, but when you die, that exclusion amount has gone back down, are you going to be in trouble? Are you going to be facing tax? And this is something that people discussed at the end of 2012 when the exemption amount was scheduled to go from $5 million to $1 million. And at the time, it wasn't an issue because Congress made the $5 million amount permanent until now. But what we're looking at moving forward are kind of two different things, and one of which is making large gifts now. We're doing some type of gift freezing technique, and all of this is kind of dependent on what happens with clawback. So we're waiting to see what happens. I would like to see some type of answer sooner than later, though I'm not sure that clawback is at the top of the list. So we'll see. So really that's kind of the long and the short of the changes. Nothing major, but there are some differences in how we move forward with planning. I will mention that when we're talking about an exclusion amount of over $11 million for this year, there's an estimate that only 1,800 decedents dying in 2018 will be subject to estate tax. That's 1,800 people for the entire country. To kind of give you a comparison, for 2017, we were about at 5,000 people. So that's less than 50% of the people we had last year who were subject to estate tax. When you're looking at a tax that's only affecting people with more than $11 million, you're getting down to slim pickings. So that changes, the way that we do business, because we don't have as many clients, perhaps as we did last year, who are subject to estate tax. So that changes the way we do their planning. Which moves me to my second section, talking about what this means for my practice. The first issue is that this concept of portability is increasingly important. So if you have a spouse, a married couple, if you have a spouse who dies before 2026, assuming that things go back, at 2026, then making the portability election to leave the surviving spouse with the dessous for the decedent is extremely important. And the dessous is the deceased spouse unused exemption. So that should allow the surviving spouse to have the full amount of the dessous, even though the exemption has gone back down for the surviving spouse. That's not going to be adjusted for inflation, but assuming that that we go back to the $5 million mark, adjusted for inflation, that's still giving the surviving spouse who lives past 2026 a large amount of exemption to deal with. And another piece is that gifting is extremely important, and of course this goes back to the clawback piece. But if a client who has a taxable estate at this point can make large gifts now utilizing that full 11 and some change exclusion amount, that's going to reduce estate tax if the donor dies or the client dies after that exemption amount goes back down. In saying that, though, we caution clients against gifting low basis assets, because the estate tax savings of doing that are going to have to be pretty major. Another kind of plan that we're thinking about now is if we have clients who previously used some of their generation skipping transfer tax exemption amount, now they've got a whole lot more to work with, so they can make late allocations of GST exemption to existing trusts. There are other kind of more advanced gift freezing techniques, which I will talk about. And I admit that these are not applicable. None of what I'm really talking about is applicable to the everyday person, but these are changes that we're making in our practice. And those are to do things like create slats, idjits, cuperts, and grats. And I'll tell you what each of those means. These are funny names that you see in estate planning. So the first is a slat, which is a spousal lifetime access trust. And for married couples, this is an irrevocable trust that can be used as a gift freezing technique. The assets contributed to the slat are valued at the time of the gift or the sale, and post-gift appreciation is removed from the donor spouses and the donee spouses' estates. And this allows married couples to make gifts to remove post-gift appreciation, but still benefit from the assets that are contributed to the slat during the lifetime of the donee spouse. A similar concept is using a single grantor idjit, which is an intentionally defective grantor trust. And we may see this with an unmarried client who perhaps has children or other descendants that he or she wants to benefit, and he or she can put those assets in trust for the children or more remote descendants, and do the same thing, which is to remove the post-gift appreciation. A cupert is a qualified personal residence trust, and with the increased exemption and gift tax exclusion, something that some of our clients are thinking about is gifting their personal residence or a vacation home to a cupert. And what they're doing is leaving their home in trust for their children or other descendants, and under the terms of the trust, the grantor has the right to occupy the residence for a term of years. And at the end of the term, the residence goes to the beneficiaries, but the grantor has the ability to rent it kind of back from them. The key to this is that you only want to do a cupert for somebody who's likely to survive the term, or else the assets that are in the cupert are going to be included in that grantor's estate. We also are looking at doing zeroed out grats. A grat is a grantor retained annuity trust to allow the grantor to remove the appreciation of assets out of his or her estate using really little or hopefully no gift tax exclusion in doing so. Kind of one important thing to remember is that we have a short period of time as of right now with these changes, which may or may not become permanent, but the way we like to operate is that clients are coming back to review their documents every 5 years or so. That's kind of what we tell people. You should be revisiting your documents every 5 years for a variety of reasons. Children are born, your income changes, those sorts of things. And so the way we draft should be flexible enough to deal with increased and decreased exemption amounts. But in certain instances now where people have formula-based estate planning documents, they need to take a look at them because the amounts that are passing to a class or group of beneficiaries may be a different percentage of their estate than they had originally intended. So for many of our clients, we may be moving to more of a disclaimer-based plan instead of a fully marital trust, family trust plan. Do I have Okay. I will make a few final comments, which is that the focus in my area may be moving away from estate tax a little bit and more to income tax. And I say that because the top rate for income tax is 37%. The long-term capital gain rate, I think, is 20%, and the top estate tax rate is 40% as of now. And the takeaway from that is that for our really high net worth clients, the balance between estate and income tax is less lopsided than it has been in the past, towards estate tax. So we're looking more at what we're doing for income tax planning. And then, of course, if the clients that fall below that, income tax may be even more important for them than it was before. So we're looking at different techniques in order to focus on that, like granting general powers of appointment, as I said before, moving to disclaimer plans, looking at the Delaware tax trap and how we can utilize that, and doing that sort of planning.
Good afternoon. I'm Bobby Johnson. It's a real honor to be here, on this side of things and actually, presenting to colleagues and students. I appreciate everybody for coming out here today. My topic to discuss deals with high-income individuals and small businesses, and that's a good overlap because of high-income individuals that haven't really been discussed already today. They probably fall into one of two categories, or most of them would. Either people that have high salaries and receive other sort of typical compensation like bonuses, guaranteed payments. These would be somebody, with a large, $200,000 plus salary at a corporation. And then the other group would be small business owners. As far as, I'll start with the wage earners, they're seeing their tax rates actually go down because of the adjustments of 39.6% at the top bracket down to 37%. The tax brackets have also, by and large, gotten larger, so more of that income is taxed at a lower rate. But on the flip side of things, they tend to be, I think, in some ways the losers, relatively speaking, of this tax bill, in the sense that, most of the people that are making over $200,000 in W-2 income are not going to get the benefit of the doubled standard deduction. They're generally going to tend to itemize, and then at the same time they're losing a lot of their itemized deductions, and or at least they're being limited in new ways. And I just want to touch on three of those that tend to be the more controversial or publicized ones. The first one, as David had mentioned, is the charitable contribution. One interesting thing about this is it actually increases the amount that you can deduct from 50% to 60% of your AGI as contributions. However, as David pointed out, much fewer people will be itemizing, or at least that's the expectation. So we don't really have a good gauge of people in this particular tax bracket, how motivated they are by the tax benefit. And maybe there are other variables, like if they're paying a lower overall tax rate, maybe they'll have more money to donate to charity. Some people donate to charity, it has nothing to do with taxes. So I think that will be an interesting one from an economics point of view to get a chance to see how that develops. The next one that a lot of these folks are going to fall into is the mortgage interest deduction. Typically families have been able to deduct a large percentage of the interest they pay on their home mortgage. Under the new reforms, there's a cap there of mortgage sizes up to $750,000. Well, if you're living in Richmond, Virginia, that's not going to hurt you too bad. You're probably pretty affluent if your mortgage is over $750,000, or you just picked a really bad lender. But that deduction is going to affect people, as you can imagine, in the more densely populated urban areas, even up in D.C. And New York, of course, where a $750,000 property may not be really a lavish property. So this group of sort of the high-income wage earners, they're going to be, challenged in that sense that they're going to be able to deduct less of their mortgage interest. And then the final one, which is perhaps one of the most interesting, is the SALT deduction. And this is the state and local taxes. Typically, taxpayers have been able to deduct most of the taxes that they pay at the state and local level, whether it's income or property taxes. This has now been curbed so that the max you can deduct is $10,000 of state and local tax. again, this is one of these things that living in Richmond, Virginia, you know, $10,000 is a pretty sizable amount of your state and local income tax, whereas, you know, if you're up in a high tax state like New York, New Jersey, California, that's going to hurt a lot more. And to that end, New York has, and other states also have discussed possible responses. As far as I know, none of these have actually been implemented yet, and you know, if you want to clarify on that, by all means. But first off, New York has discussed challenging this bill as unconstitutional. I'm not a constitutional attorney, but I think you'd need some pretty artful pleading to really make that hold, because there are all kinds of things throughout the country that are taxed unfairly depending on how you're looking at it. So I don't know that that'll gain a lot of weight, but you know, we will see. You know, but for instance, like in Manhattan, I've seen numbers that, you know, the average citizen or resident is deducting about $60,000 a year on their tax return, itemized deduction. You know, that's going to really hurt them. And that's about 45% of the population also itemizes. Now, that's just Manhattan. That's, of course, you know, kind of an extreme example. But one of the things New York has proposed is, you know, what's the best solution to higher taxes? More taxes. And, you know, what they've proposed is a new payroll tax. And so the idea is, you know, that wage earner who now has, you know, whatever percentage of tax comes out of his salary every pay period to go to state taxes, that they wouldn't be responsible for paying that at their level, at the individual level. Instead, you know, the business would have to pay basically double their portion of the payroll tax or some scheme like that. So, you know, the interesting thing about this is that, well, that what the business would be paying would still technically be deductible by the business at the corporate level. So the idea is it would kind of net out, and maybe there'd be some tax credits thrown in by the state government to make that more appealing for an employer. And they've also talked about making that sort of thing potentially optional. So businesses would sort of have a little bit of flexibility, to pick and choose if they want to choose that sort of thing. You know, that seems to me kind of administratively difficult. I think most people who go to work for companies in New York aren't going there because of the tax benefits they can deduct. They're going there because of the employer that's there. So if you're raising the corporate taxes, you know, that could have an unintended consequence as well. Another option I heard floated around, which I think is kind of amusing, but you know, it could work, and they're talking about allowing taxpayers to donate money to the government. And as you're aware, as we just discussed, you still have the charitable deduction. So basically, if they donate part of their salary to the government, the state government, then they can, you know, that's a donation, it's a charitable, and they don't have to pay taxes on that. Obviously, there'd have to be, you know, some sort of credit system set up, and it's hard to envision a plan that would be sort of economically efficient by this sort of donation. But at the same time, you know, these are some pretty creative ideas that have been proposed to get around, you know, what is seen as geographically a disproportionate tax. What I think we'll probably see if these things stay in effect over the long term, and there's no constitutional, you know, upset of that, is you'll probably start to see more uniformity amongst the states in the way they tax. So that would be what I think you'll see instead of these sort of elaborate tax formulas. And then just to switch gears, so next you have sort of the pass-through entities. These are, most small businesses are pass-through entities. And so what's meant by a pass-through entity, as many of you probably already know, is that, you know, when your corporation or your LLC makes a profit, you report that on your personal tax return. The corporation, the business, doesn't actually pay income tax. And there are a lot of beneficial reasons for that. The main one, which I'm sure you've all heard of, is the double taxation, which is, you know, if I'm a regular C Corp like Walmart, I have to pay tax when Walmart earns the money. It used to be at around 35% at the top level. And then when I take that money out to put in my bank account as the owner, I have to pay an additional tax, probably 15 to 20% on that. You know, you're getting to a pretty substantial amount of income. So for most small businesses that don't have to choose the C corporation, you know, taxing method, it was kind of ludicrous under the old plan, unless you had some very specific circumstances, to you know, elect to be treated like a C corporation. With the new rate reduction to 21%, you know, I think more consideration will be given to the small, medium-sized businesses as to whether there's a good economic reason to choose the C, you know, the C structure, and I think there certainly are. For instance, if you want to try to keep more of the cash inside the business in the early years while you're trying to grow, you know, it'd be nice not to have it taxed at the investor level so that you don't have to distribute out money to pay the taxes. But obviously, as you can imagine, it takes a lot of accounting and, you know, thoughtfulness and predicting what's going to happen in the future to really make that efficient. So, and then the other side to that is that, and it makes sense from a political point of view, but from a policy point of view, I don't really see that it's as logical. And that's, you know, now all these pass-through entities as part of this, there's, you know, up to a 20% reduction of your income. So if I'm a pass-through entity owner, I get my, you know, compensation or my percentage of ownership interest at the end of the year. In a lot of circumstances, you're going to be able to deduct up to 20% of that from your business income. And, you know, I can't get into too much detail about how that works because there are some elaborate rules that sort of govern that. But what I will say is, from a policy view or political view, it makes sense in the sense that, you know, well, the big corporations are getting deductions, the poor people are getting deductions, you know, where's our deduction, pass-through entities? And so it's sort of thrown out there to sort of appease that group. But I think from an actual policy standard, in terms of does this make sense, is it logical, there's a good reason why pass-through entities, you know, maybe shouldn't get a 20% discount. So I think that is one of these things that it's appealing, but it's kind of inconsistent with some of the traditional policy considerations. That being said, it is limited. Unfortunately, as most people in this room are probably upset about, it doesn't apply to service industries, specifically lawyers. That's one of the categories. Somehow engineers and architects seem to get out of that. I'm not really sure. They've got some good lobbyists, I guess. But the good part about that, and this would be most people, especially, you know, attorneys that are just starting their practice or haven't been practicing for that long, is there's an exemption amount of, you can still deduct the 20% of your pass-through income to the extent, and there are other requirements, but if it's like 100 and, I think it's was it? 157. Yeah, 157,000 a year, or if you're married, you know, double that. So, you know, again, this is one of these things that if you're working in Richmond, Virginia, have a law practice here, that's going to be, you know, very beneficial to you. You're probably doing pretty well if you're a married family or making over $350,000 a year. On the other hand, if you're in New York, it's not that uncommon for, you know, a household with 2 college-educated folks to be making that kind of money, and they're not necessarily, you know, considered wealthy from a relative point of view. And so that's probably the biggest thing in terms of these small businesses, the benefit to them or change that's going to affect them. You do have another thing that I think will affect some of my clients is you can now only deduct up to 80% of your adjusted gross income through a net operating loss. And what I mean by that, if I have a loss this year and I didn't carry it backwards, but next year I have some profits, I can take that loss and maybe cancel out all my taxable income that I get through the business. This nets it at 80%, or, you know, caps it at 80%. So even if I had a really bad year this year, next year I'm still going to have to include some of my income in tax, or as taxable. And then there are a couple other things that will probably affect larger businesses more than little businesses, but, you know, there's increased depreciation in certain circumstances, and you also can expense there's a higher threshold for, tangible personal property that you can expense. And another thing is the business interest debt. Usually businesses or historically have been able to deduct, almost all of their interest debt or interest payments that they make. Now that's sort of capped. They create this thing called net interest expense, and it's limited to 30%. So these are things that are going to affect probably larger businesses more than smaller businesses, because, for instance, that net or capping the interest expense, that doesn't apply to businesses that are earning less than $25 million a year. That's going to be most small businesses. Also, and this will help kind of medium-sized businesses, but you're not required to adapt the accrual method. You have two accounting methods, cash and accrual. Accrual is administratively a lot more difficult. Cash is a little simpler from an accounting point of view. There are benefits and drawbacks to both, but now it used to be if you had over $5 million in income, you had to use the accrual basis. That has shifted to $25 million, so that will help some folks too. So I think those are kind of the main ones I wanted to touch on. And I know I'm running out of time here, so I think I'm just going to turn it over for questions.
Yeah, thank you, everyone. Thank you for the panel. So